the slides.
So, Mike, I think the thing that I'd love you to incorporate into what you've already prepared is how do members in Freedom Warrior look across the suite of trusted advisors? So these are people who, you know, we've done good due diligence on, and we're bringing them to the table with vetted deal flow. How do we use this idea that you've created and use it to make better investment decisions?
Sure. Appreciate that. I mean, it's the right question. Let me kind of roll you through the slide deck. Your slides 100 times better than mine. My slides got way too much language, way too much bullet points. Yours are much more, you know, better presentation. So just bear with me. This is how my mind works.
Terrific. Yeah.
This is a mathematician and a finance guy. Unfortunately, they're not pretty slides, but they work. So let me run. Okay, let me see.
We don't invest in you because of your slides, though, Mike. We just invest with you because we love the way you think.
Thank you. Yeah, if people invested, by the way, you know, I look a big guy, 6'4", a little bit on the chubby side, and maybe I wouldn't have any investors, but appreciate that. Okay, wonderful disclaimer. The short version of it. If you're interested to invest, request private placement memorandum. This particular presentation is for educational, informational purposes only. Well, you've seen this. Most of you know the family. Married 21 years, 4 kids and a cat, 5th child. I don't know where's the cat. She's always hanging out near me. Bunch of new podcast episodes coming out. So really interesting stuff coming out. Feel free to listen when you're bored. You have nothing else to listen to. A new book is coming out too, version 2.0. Okay, well, people that invest with us, we'll skip this. Most of you know all this story. Okay, quadrants. So let me just say this. You've all seen the quadrants. I'm going to cover them very, very quickly. Quadrant 1 and 2 are investment grade, and quadrant 3 and 4 speculative grade. Quadrant 1 and 3 cash flow quadrants. Quadrant 2 and 4 are growth quadrants. The most important message here is that all projects have risk, and you have to adjust for risk. There's, generally speaking, more risk in quadrant 3 and 4 deals and less risk in quadrant 1 and 2. Every quadrant has risk, and you have to adjust for the risk. Also, quadrant 3 and 4, being speculative quadrants, have higher volatility. So when I adjust risk-adjusted ROI, for example, for quadrant 4, you see 8 to 18% range. Why such a broad range? Because it's a lot more volatile. Sometimes the project will do great, and sometimes they will do not as good. Volatility is higher. Risk adjustment is most certainly higher. And then same is true for quadrant 3. Quadrant 1 and 2, they're much more stable quadrants, lower level of risk. Risk adjustment is lower. And the target return range is sort of more compact because volatility is lower. But I wanted to make sure that folks understand the fact that a deal belongs in quadrant 1 doesn't necessarily mean it's a good deal. The fact that a deal belongs in quadrant 2 doesn't mean it's a good deal. Quadrant 4 doesn't mean it's a good deal. And we'll cover this. What I see again and again when there's a quadrant 4 deal and the sponsor pitches it as a quadrant 2 or 1 deal and offers investors returns corresponding to quadrant 1 and 2. That is not a good situation. What you want to do is get a quadrant 1 and 2 deals with returns that correspond to quadrant 3 and 4. That's the key, is picking the deals that have the right risk-adjusted return. So that's the key message.
Just before you move on from that, Mike, we should just make it clear to everyone watching this as well that when Mike is putting up these returns, guys, he's specifically referencing the alternate space in the US. This is not a reference to asset classes, for example, in Australia. Is that correct?
Correct. We'll go one step further. These returns is a snapshot in time here in the US in real estate in my world, what I see in the deal flow. Things change. Sometimes things get better, sometimes things get worse. As interest rates have fallen, yields have compressed. It's become harder to get same cash flow as it was in the past. So absolutely changes in time. It's a snapshot in time. It doesn't mean this is what you're going to see. You may see better numbers or worse. And it's generally real estate. But I wanted to show you the picture. If you start with a speculative deal, Quadrant 4 deal, where the sponsor says the projected return, the pro forma, as a technical term, 15 to 25%. Again, I'm using a range, but generally speaking, most of these projects will be offered with this great rate of return, strong return. You have to adjust quite a bit for risk, and your actual risk-adjusted return is 7 to 18. It's a whole lot lower. That's the key message. So I'm not trying to use this as an example of what the deals you will see. It's just the fact that you see a deal and you see a target return and you understand it's a Quadrant 4 deal and you have to adjust for risk. When you think about it, it will only generate you 8 to 18%. And you think on average, maybe it'll do 12. Is that worth the risk? Again, that's the key message here. Okay, so a few quick examples of what deals in real estate falling in different quadrants. I'm going to go through this stuff quickly, but these are classic examples so you have an idea. So if you do a first lien performing mortgage or loan at a low investment to value ratio or conservative investment to value ratio, you made somebody a loan or fix and flip project at 65% loan to value ratio. You're in a first lien position, senior on a capital stack. It's a safe loan. It's a Quadrant 1 deal. Now you're going to ask me, hey, is the conventional mortgages that the banks give you a good deal? I'm going to tell you it's terrible because they're giving you money at 3% for 30 years. To me, it's the risk-adjusted return is terrible, but it's a Quadrant 1 deal. So it's an example. Now, if you're going to get 8 to 10% at the on a fix and flip project with the right sponsor, the right level of risk, that's an adequate risk-adjusted return. So again, example of a bank loan, in my view, it's terrible. Terrible deals for the banks. Why banks do it? Because the government tells them to do it. They give them money at 0 and they tell them go lend at 3. That's the whole point. So is this a prudent long-term investment? If you were an investor, would you buy a long-term bond that generates you a couple percentage points for so many years? The answer is no. It doesn't make any sense. Inflation will erode it. Your actual risk-adjusted return is negative. So, but let me continue. So Quadrant 1 deals, some of the turnkey houses, if you buy a good turnkey house, well done, with low mortgage leverage. So you buy a house, maybe $100,000, you put in 30, 40,000, you get $60,000 mortgage, you get good cash flow, and you feel good about the market itself, sort of generally a somewhat appreciating market. Maybe it's a decent Quadrant 1 deal. Now, if you're going to buy a house with heavy leverage and in somewhat speculative market with no reserves, I mean, will not meet the Quadrant 1 requirements. Anyway, on the commercial side, I call them cash flow syndications with low leverage. What I don't like to see is over leveraged deals, but a good deal maybe with 70% bank leverage at a cheap long-term mortgage with a good debt service coverage ratio. It's a technical term, DSCR. It just says the cash flow in the deal is strong to cover the mortgage and you're generating good cash and has good returns. Those type of deals can fall into Quadrant 1 or similar funds. Now, if you look at Quadrant 2, you have some first lien non-performing mortgages, distressed debt at low LTV. That's the key word. They fall in Quadrant 2. What's the difference? Well, difference one, performing loans pay interest. Non-performing loans, they don't, they accrue. So some value add syndications, multifamily and whatnot, that have a break-even cash flow. A lot of renovations, they take place, but through the life cycle of the project doesn't lose money. So the cash flow is limited through the value add phase, but at some point it picks up. I like those. Again, distressed debt funds as well. Quadrant 3 deals, some examples. Second lien mortgages, cash flow syndications with higher leverage, 85%, 90%. Mezzanine debt, junior debt, some preferred equity. If you're not in senior position, generally they are Quadrant 3 deals. And Quadrant 4 deals, pretty much all speculative deals. Development, redevelopment, land speculation, heavy value add syndications with negative cash flow through the value add phase of the project. They all kind of fall into Quadrant 4. Now, there are some deals borderline, and just make a pick. You can have a Quadrant 4 deal that's borderline with Quadrant 2, and it's your decision. Just understand it's not black and white. Sometimes it's a little bit gray. Okay, so real important point. Deals in the same quadrants could look very different. So here's an example. We're going to talk about deals that are obviously speculative, and it goes back to the typical Australian investor product. What is that typical product? If I understand this correctly, it's a big city investment. It doesn't have to be a big city, but this is how I view in the US methodology. You get a mortgage 75%. That's probably as high as practically you could get on a investment property. And you have negative cash flow, maybe 3%. So I experienced in New York City, same exercise. You put a big down payment, you pay closing cost, and you can't break even. You're losing money. What's your hope? The hope is that the tide rises all boats. Oh, it's been like this for the last 20 years. Wonderful. What if the pattern changes, right? So if the pattern doesn't change and you continue to get 10% appreciation every year, you lose 3 cash flow, your net is 7, you have a leverage, you may have cash on, not cash on cash return, but return on equity with leverage that will exceed 20%. Can that happen? Absolutely it can. This is a classic example. Again, you could put in, take $1 million property, put $250,000 down, and 5 years later, the $250,000 could look like $750,000 or $500,000. That leveraged growth could take place. Is anything wrong with the strategy? Yes, it's a single-minded, single strategy. Can you do the strategy as part of diversification? Yes. Should you do just that strategy? Probably now. Probably you should consider some alternatives. It can work until it doesn't. Anyway, again, the primary risk of the strategy, if the market appreciation stalls, you have a negative ROI. You have no appreciation and negative cash flow. That's the primary risk. Now let's look at the value-driven strategy in Quadrant 4. Same ROI as without the value strategy, but you also have forced appreciation driven improvements. So an example, apartment complex is going through renovation, and you can, all the complexes in that area with natural appreciation can go up by 10% per year. But yours is going to be ahead. Why? Because you're going to renovate units, you're going to renovate apartment complex internally, externally, increase rents, and wind up with forced appreciation because it's driven by the value at work. So in general, I like to invest in projects that have that are in good appreciating market, plus they have a value strategy. That way you have benefits of both. If things go well in general, that's great. Even if things don't go well, the value strategy at least creates the safety and the upside in the deal. Again, there's a risk. This primary strategy has another risk. You're going to say, is this better than the other one? Not necessarily, but as a diversification strategy, they both complement each other. Primary risk value strategy must be executed by a very competent operator, or return on investment can go negative. I've seen this happen. For wonderful upside, everything is great. The operator fails. They can't complete the construction. They're stalled. They ran out of money. The cost of materials went up. So this has to be done with the right operator. There's absolute risk related to value add, and if it's not executed properly, you can wind up not making any money, even losing money. So let me continue. Okay, what makes a good deal? Probably the most important slide in the whole presentation. So when you think about what's a good deal, well, you got to remember 3 things. You absolutely have to have all 3 things. If one of them is missing, can't do it. It's no good. So good or great sponsor. Imagine you don't have a good and great sponsor. You got a good marketing message in your email from a wonderful sponsor, self-claim billionaire, millionaire, gazillionaire, who have done 20 other projects, who have succeeded 20 other ways. You don't know who they are. You can't verify it. And you wind up with a bad sponsor, but who's a great marketer, right? You could lose all your money 20 different ways. Doesn't matter what's written in the documents. You get an idiot, they will find a way to mess up the project or steal the money. So you have to start with a good sponsor. It's a number 1. That know, like, and trust is critical. If you can't establish that, you can't invest. Number 2, has to be deal with excellent economics, at least good economics on the deal level. So what does that mean? It means whatever the strategy, whatever the plan, the financial projections, some of the basic stuff, let's call them strong deal fundamentals. If it's a value add deal, basically you have healthy cost basis. Your purchase plus the value add cost relative to the future value has to be such that there is a good upside. There is a capable sponsor and operator to execute the strategy, but on the deal level, you got to make a good return. So people are going to ask me, what's a good return on a deal level? Well, depending on what kind of a deal. If it's a low risk quadrant 1 and 2 deal, the total level return could be 18, 20, 22, 25%. It's a lower number, but generally it's probably still, in my view, again, in the deals that I see, they're probably in the very high teens at the very minimum. Otherwise, it's not exciting enough for me. On the other side, if it's a quadrant 3 and 4 deal, there's a lot of risk. I want to see deal level target return of at least 30% or higher. Why? Because there's a risk. We got to adjust down for the risk, which is, we talked about that. 2, the sponsor's got to make a buck and investors got to make a buck. That split has to be. And if that split is not enough return on a project level, then either investors don't get their fair shake or the sponsor is not motivated to do the work. So project level or deal level economics have to be pretty good. And obviously well understood and well planned value as strategy and readiness for contingencies. So if that's done well, it creates a good project with good or great risk adjusted return on the deal level. Now we go to the third element, which I see all day long out there with good sponsors, good deals, but not necessarily great terms. So what do I like to see? When we look at these deals, we're looking for strong risk-adjusted return for investors. So they get their fair shake. If the deal makes it like a bandit, it's a home run, then investors have to hit a home run. If the deal doesn't go so-so, investors are treated kind of the first, they have some protection mechanism. So that creates a balanced risk-adjusted return. Again, investor-favored economics corresponding to the risk level, which it generally includes preferred return and a performance split. I'll show some examples. And an alignment of interest between the sponsor or fund manager and the investors. What I like to see is the fund managers get compensated mostly on a back end, some as you go, little upfront, right? So that way, if things don't go well, investors get their money back before sponsor makes it like a bandit upfront. Okay, so lots of shiny objects offered by good marketers. Just cannot stress this enough. So much shiny objects is not even funny. There's guys who know how to market. They know how to build know, like, and trust through educational platforms, thought leadership, and they bring a lot of mom and pop investors. And you don't want to be a mom and pop investor. You want to be a sophisticated, smart investor. They bring them into the deals that make them look good with high IRR targets driven by very aggressive assumptions in underwriting. But they're heavy in fees, and they're putting investors at high risk and low reward. This is the problem. Investors take the high risk and low reward. That doesn't work. On average, it's a recipe for a money-losing proposition. Here are some examples. So 90% of the deals structured for mom and pop investors, they don't have good risk-adjusted return. They may have a decent sponsor, good or decent deal level of economics, but bad investor ROI. Pay attention to this. Obviously, start with good sponsor, good overall deal, but the investor economics critical. So let's talk about it. So sponsor makes heavy upfront fee or ongoing fees. I've seen some really crazy stuff. Sponsor makes 10, 12% upfront of all the money the investors invest. They take it upfront, they pay it to some third-party broker-dealer, and that broker-dealer happens to be owned by them. I've seen some really creative ways people do it. When they look at it, it's like, whoa, how can that be? Well, that's good for the sponsor. It ain't good for investors. So investors could receive a decent pref, like 8%. But often investors will receive the ongoing payments without the supporting NOI in the project. You have to understand where is the income coming from. Most of our deals and funds, if we don't have NOI, we're not going to pay the pref. We're going to accrue the pref, but we'll pay it when the deal succeeds. So if you're getting the payments on a growth deal and there's no supporting NOI, danger zone. Why? Because we're a Ponzi scheme, right? They overraise the capital, keep feeding investors until the music stops, and you may be in the middle of that fund. Yeah, you received your payment, but the music stopped and you lost most of your money. And then the split could be heavily in the benefit of a sponsor, not investors. It's 10-90, 10 to investors, 10 to the sponsor. That's wrong. 20-80, again, 20 investors, 80 to the sponsor. 25-75. What I wanted to see in the reverse direction, where investors get 80% of the upside and sponsor gets 20, right? That's a fair shake, not the other way around. Please understand, sponsor has to eat. I'm a fund manager too. I got to make a buck. But at the same time, if it's set up like this, though, the investors will never make it. Well, let me correct it. Sometimes they'll make a decent return, and sometimes they'll fail miserably. On average, they won't do good. And the sponsor will always make good, regardless of what happens to investors. So this setup just doesn't work on a long-term basis. It doesn't provide the right risk-adjusted return. Again, here's an example of mom and pop deals. You could have a good or great sponsor, and a deal could says, hey, we'll pay you 8% interest monthly or quarterly, and we'll give you 1/10 of the projects. I'm sorry, 10% of the profits, 1/10 generated. Additional return to investors, another 4 to 8% per year. So the total target is 12 to 16%, for example. That's a pretty good target, right? It looks good on paper. Here's the problem. The problem is sponsor leverages investors' money for a development projects. So they basically, the money is leveraged with bank financing, creating risk. If the projects fail, all the money is gone because the bank will get their money first. So they wind up being in quadrant 4 deals, especially development type of deals, with a lot of risk and massive upside too, right? The sponsor could make, on the annualized basis, due to this leverage in the development, 40 to 80% return on investment on the project level. But investors will get only additional 1/10 of that. I hope it's beginning to click in. So of the 40 to 80% upside in the project, investors get another 4 to 8%. So, and the sponsor will be left with 36 to 72%. So what will investors make? Well, they'll get the 8% interest, and then they'll get another 4 to 8%. If a project succeeds, investor upside is 12 to 16%. And that's the cap. There's no home run possibility. This is a pretty good double, all right? It's a good return. Nobody's arguing. But the project generated so much more upside. Now, the total 40 to 80% generated, how much of that has gone to the investor? Well, take 12 or 16 and you divide it by 40 to 80. What do you wind up with? Investors receive total 20 to 30% of all the money made on the project, while the sponsor captured 70 to 80. To me, this is terrible risk-adjusted return. What we do, again, we have the reverse. Investors capture 70%, we capture 30. Or investors capture 80, we capture 20. When there's a home run, let investors capture the home run. That's what makes correct, good risk-adjusted return. Because a project can fail. When it fails, all the money is gone. Doesn't matter if all these upsides split because it won't make any difference. It'll be just gone. But when the project succeeds, having this type of a setup with a bad setup will limit investor upside, and that's catastrophic as part of the mathematical formula. It won't work. You'll have 10 deals that'll generate 12% and a couple that'll fail completely. On average, you probably lose money. So with the home run capability, when you get 10 deals and some of them will make 60, 70% return, you'll make up for the losses because of that. So that's how it works. Now, success of a portfolio with investments in quadrant 3 and 4, very specifically in speculative quadrants, depends on getting the home run returns when the deals go well. This is the key point. The same is true, by the way, for quadrant 1 and 2. You absolutely want to have capture those, but quadrant 1 and 2 have less of these volatility, probably less chances of hitting home runs and less chances of complete failure. So for quadrant 3 and 4, this is absolutely paramount. So here's some examples. The The quadrants 3 and 4 deal must receive fair upside for potential big success to compensate for the risks of losses when the deals go terribly. And again, conservative underwriting is obviously important. Some kind of a pref, 8 to 10%, again, as an example. Why pref is important? Because without the pref, investors are not getting compensated for the fact that they're being patient. So something has to accumulate every year. When the project ultimately completes and sells, investors got to get paid first. So having a pref matches this methodology. Investors come first. So if the project goes so-so, not terribly, at least investors will get the pref level of return. Anyway, and then the split above the pref. The split above the pref has to be, in my view, in most situations, 70-30 or 80-20 in favor of investors, not the fund. Can you be 60-40? It can. It's a little bit light, but it's possible. But again, in favor of investors, not the fund manager. Also, what I do see from time to time, some funds or syndications will have what they call IRR hurdles, where if you start with an 80-20 split and you get investors to 16%, every dollar above that gets split 70-30. That's okay, because it got investors to at least that 16% target. So that waterfall is critical to generate risk-adjusted return. Also, what I don't like to see is when the sponsors charge a lot of money up front. 1 to 2% asset acquisition fee is reasonable. Light upfront fees, light asset management fees as you go. All those things in combination create right risk-adjusted return. Now you're going to tell me, where am I going to find those deals? Well, they exist. It's harder to find, but they exist. If you're going to settle for deals that don't look like this, you're going to wind up with a whole bunch of singles and a couple of complete strikeouts. You're going to lose your shirt. So that's kind of a key message here. And I see from time to time sponsors offer returns that sort of look safe because it's debt. Oh, you get a promissory note. Well, it looks safe because it's not really safe. It's just the sponsor puts a lipstick on a pig. I don't know how else to put it. I know great sponsors that do it, and they're very successful. They do a great job with makeup on a pig. So the risk has to correspond with the reward. That's the key message. Here's an example of a home run. We just had it. We just had the deal. We invested in the deal. And off the top of my head, I had 9 pref and 75-25 split above 9. We received 75% of the upside. So this is a deal. We invested in May 2019, $250,000 from Tempo Opportunity Fund in Ogden, Utah. It's a conversion of Bigelow Hotel to Bigelow residences to apartments. The deal was a home run. It was projected to sell for $18.8 million in 5 years. Instead, it just sold in February for little over $20.5 million in less than 21 months. The deal had leverage, had high degree of risk. The equity was only $2 million. So the leveraged equity made the investors a home run return. Original projected return was 25%. What we wound up receiving after all sponsor fees, which were the 25% of the upside, not 70. We got 75, they got 25 after 9 pref. On this deal, we made 73%, over 73% IRR. So what does it mean, all this fancy math? Well, we wrote $250,000 check. 21 months later, we got 546,000 with change. That's a good home run. So this is critical. If you wind up with this kind of upside when the deal succeeds, you'll make up for some losers. Imagine we had 2 deals like this, just like this. One was a home run like this, one is a complete loser. We would have still wound up with a reasonable return. This is the key message. Again, there are institutional, opposite to mom and pop sponsors with excellent offers. There are a few of them, 1 in 10, probably less. And again, you're looking for quality sponsors. Salena, I think you had, I don't know if Lance from VeryVest
He's speaking with us, yes.
Yes, so we like sponsors who are VeryVest verified. We're one of them. I know they don't let the crap come through. No guarantees. There still could be not ideal situations, but at least it's a layer of defense. Good, great deals, investor favorite economics and risk-adjusted return. Sorry, I'm biased to my own funds, but we set them up this way, the institutional level funds, Tempo Growth and Tempo Opportunity Funds. I'll show you what a good waterfall looks like. Again, Tempo Growth Fund. Yes, it's a mix of quadrant 2 and 4 deals. But look at the bottom of this thing. This is the waterfall and the compensation. So as a fund manager, we're compensated 2% management fee. Investors get 8% pref to offset that. We charge only 1% asset acquisition fee. There are no other fees other than the performance fees on the back end, 20 to 30%, what is known as the performance carry. The way this works is investors get 8% cumulative preferred return, and then depending on the class of units, they get either 80 or 70% of the upside. The waterfall actually is 8 pref cumulative, then full return of capital, which works even better. Before any performance fees are paid, investors have to receive their money back. 8% cumulative pref, if the money is out 2 years, that's 16%, 3 years, 24%. Then full return of capital, and then the performance split. It creates alignment of interest, and nobody gets rich and fat. Maybe I just get fat, not rich. But nothing fat up front. So institutional level product, we like it. We're here for the long term. We want investors to feel they're getting the right shake, the right split, and overall, this is why we feel pretty good about target 12 to 18% risk adjusted. Why? Because most of our deals we underwrite to generate 20% plus. So when we generate 20% plus and investors get, say, 70% of that, right? They'll get 14, we'll get 6. Is that a fair shake? Yeah, it's a much better shake when the reverse happens. This is the critical message. So in a case of a home run, investors will make a home run. In case of a challenging situation, the investors will get the 8 pref. We still, the 2% annual management fee is required. We got to keep the lights on. I got a team. At the end of the day, some compensation to the manager is absolutely reasonable and appropriate. But what I don't want to see is the reverse, as we talked about, the deals with investor, with sponsor favorite shake. So Tempo Opportunity Fund, very similar concept. Again, this is probably a diversified fund. So this fund has a little different waterfall because it's an open-ended fund. It has 7% pref, and then performance split kicks right away. There is no concept here, return of capital. Return of capital would be a redemption. But the fees here, this fund has even better waterfall setup. So fund manager gets 2% annually. We don't charge any asset acquisition fee. We don't get paid at all to put the money to work. 0, 1%, it's all within reason. When you see a big asset acquisition fee, that's a concern. And we get 20 to 40% of performance split after we meet 7% cumulative preferred return. That's how it works. It's absolutely within reason. And you're going to ask me, hey, are you making enough money as a manager? I'm going to tell you, you know what? We set up these deals a little too good for investors, and we're learning. I mean, in reality, I probably would like to have a 1% asset acquisition fee in this fund too. It's okay. The bottom line is, if we take good care of investors in the long run, it's good for us too. So that's the spiel here. Obviously, VeriVest. So we are VeriVest verified. I think Lance is going to speak. I'm really delighted. Really important. We also like third-party administration. We use them to administer. What I absolutely dislike when people run their own administration. Why? Bernie Madoff. They can cook the books. They can do whatever they want. And that's a problem. To me, I would rather have third-party administrator than in-house accounting. Am I implying everyone is a crook? Absolutely not. There are plenty of legit guys running stuff inside. But it's better to have third-party administrator, and then Tempo Opportunity is audited for third party. Now you're going to ask me, should every fund be audited? And the answer is it depends. So when we started, we thought it was a great thing. If we used in-house accounting and administration, an audit would be a must. When we moved to VeriVest and they run all the books over time, we realized the audit is just a third layer of verification. So audit doesn't hurt, but it's an extra expense for the fund. So for Tempo Opportunity, we implemented. For Tempo Growth, we decided we don't need to because VeriVest does all the books. We're not going to do any funny accounting. It's a third-party administration. So it doesn't hurt to have an audit, just an expense for the fund to run it. And and a little bit of extra work for the manager. As auditors can be, pardon me, a pain with all the love and respect that I have for auditors. They ask a lot of questions and they drive you sometimes nuts. Yeah, that's it.
Awesome. That was fantastic, Mike. I'm going to stop there.